The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon. My name is Christopher Cahill, 12 Points Wealth Management. It is now noon on Tuesday, November 19th. Our monthly webinar series is continuing here. This month is Tips for Strategic Giving. 'Tis the season. Thank you all for joining. I'm going to be respectful of your time and that we're starting here today at noon. I'm going to try to get through this as quickly as we can, provide time for questions at the end, if any. Otherwise, you'll have my contact information and you can follow up with me directly. Certainly welcome the opportunity to speak with any and all of you on these topics. So, Christopher Cahill, as I said, I'm an attorney, certified financial planner, and a chartered advisor in philanthropy. I run the family office services practice here at 12 Points Wealth Management. I work with wealthy individuals, high net worth families, primarily focused in the world of lawyers and law firms, most recently. So today we're going to touch on all manner of gifting, both charitable gifting and gifting to families. And I'm looking forward to covering this topic. It's certainly something that's near and dear to my heart. And thank you all for taking the time out of your day to join. So, how do you make the most of your gifts? Whether you're donating to charities or gifting money to loved ones, we're going to go over all of these topics today. We'll teach you the tips and tricks to make the most of your generosity, going far beyond simple tax deductions. Today we're going to talk about gifting, the gifting spectrum, which really encompasses cash gifts, appreciated assets, stocks, things like that, mutual funds, and or more complex assets, real estate, etc. Maybe life insurance policies. We're going to talk about maximizing your gift, helping your children understand the value of money, and we're going to talk about gifting to families, as I said. So there's a lot to cover today. So without further ado, we're going to just jump right into it here. Gifts to charity. So we're approaching the end of the year. This is primarily the time when most people tend to give to the causes that they care about. But why do people give, right? They are looking to make an impact. There's a cause that they care about. There's an organization that they're particularly connected to. Maybe it's some organization that's touched them or their families or a loved one in some way, shape, or form. Maybe they're trying to leave a legacy and really kind of have a name for the family and what they've done and leave a lasting impact. Maybe it's as simple as they made a commitment, said, you know, we'll give X amount over the next 5 years. At the same time, giving to charity makes us feel good. So for whatever reason, I applaud you for being interested in learning about this topic more and for being as philanthropically inclined as I know many of you are on the call here today. So today is, in fact, a great time to give. As we know, the market is up pretty dramatically this year. I think the last 2 years have been surprises to many of us, me particularly. The rate with which the S&P 500 type stocks have grown. And that's good news because that gives many of you that are philanthropically inclined the opportunity to take those gains and gift them to charity. You know, giving assets that have embedded capital gains in them directly to a charity is a really great way to avoid paying the tax yourself and gets the most bang for the buck to the charitable organization, clearly an important thing. And at the same time, there is a great need today. You can just look out your window, look at any city or town that you live in and recognize the needs both here and elsewhere throughout the country, et cetera, across the globe. There really are staggering needs out there. So great time to give for sure. So charitable giving in your taxes, right? So many people focus on philanthropic giving because of the tax benefits. They've been muted a little bit by the 2017 Tax Act. Doesn't mean that they're not real benefits to giving to charity above and beyond taxes. There are, but not everybody is going to get the benefits that they might have reaped pre-2017 Tax Act today. So, you know, deductions must be itemized in order to claim a charitable contribution. That's a big difference. Charitable contributions to individuals cannot be deducted. Important to know. You can't receive anything back. So if you're making a contribution, make the contribution. Don't anticipate or expect to receive anything back. If you do, that will impact the amount of the gift that you've given, certainly. You need to document your cash contributions by a bank record or writing from the charity. You need to get written acknowledgement for all gifts in excess of $250, excuse me. And they have to be complete. What does that mean? You have to actually give the money and have no strings back to it. Donating appreciated assets results in a deduction of the value of the asset, but also avoids capital gain, as we said. Really important. We'll show you the mathematics on that in a moment. There are limits to deductions. Those are important to pay attention to. And different types of assets or recipients generate different types of deductions. So just know that depending upon where you're giving, what type of asset you're giving, will potentially impact your charitable deduction to the extent that you're able to take one. Okay. So traditional cash gifts. You know, we're going to talk here about the best ways to give cash, how to document those cash gifts, and making the most of them. So the reality is donors still primarily give cash, checkbook giving. Fidelity's charitable arm here says 79% of donors give cash. That's an astounding number to me. That means that only 21% of others are contributing assets aside from cash/checks. Probably not the most efficient way to move assets. Charity is the form of cash, especially if we've got appreciated assets, as we talked about a moment ago. I'd pay particular attention to that if I had appreciated assets and I was philanthropically inclined, like I know many of you are. So again, if you're going to be giving cash to charity, you want to make sure that you get a receipt, that you have documentation of it so that you can claim it to the extent that you're able to or want to on your taxes. Appreciated stock. This is really, I think, an important component to pay attention to here. So you really want to pay attention to the after-tax cost of the gift. So let's look at an example here. Assume that you're in a 28% tax bracket and that you're going to contribute $10,000 in either cash or appreciated securities with a cost basis of $2,000. So you've got an $8,000 embedded gain. The first column that you see here under cash, if you give the $10,000, you saved $2,800 in income taxes. That's fabulous. So your after-tax cost of that gift is $7,200. Not bad. Now, if you were to give the $10,000 in securities that are appreciated, you would avoid the income taxes saved of $2,800, same, but you'd also be able to save the capital gains tax on the gain, that $8,000. So the $1,200 comes off. So here, the after-tax cost of getting $10,000 to charity with the securities is $6,000. So that's a significant improvement. And obviously, the larger the gift, the more impact that has. I just used a nice round number here. But no, if it was 100 or a million, whatever those numbers are, those savings will exponentially increase as well. Again, the gifts have to go directly to charity. This is an important component. But again, appreciated stock not only provides a charitable deduction, but also potentially, avoidance of capital gains. So a great time to be paying attention to that. So, more complex assets. IRAs, many of you have probably heard this qualified charitable distribution. To the extent that you're 70 and a half and you have assets in a IRA, you can make a distribution directly from that IRA up to $100,000 to a qualified charitable organization, and it won't create taxable income to you. It will help reduce your required minimum distribution off the IRA. So for those of you that are in that point in your lives where you're beginning or taking your required minimum distributions and you're philanthropically inclined, let's talk about your IRAs as a funding vehicle. Again, it's capped at $100,000, but you can do a lot of good work there, and it's a really excellent trick and tip to utilize the IRA assets for this qualified charitable distribution. Certainly, there are other assets that one can give, complex, maybe non-publicly traded assets, things like real estate, business interests, or life insurance policies. These vehicles can provide tremendous savings to you and allow the charities to reap big rewards. These sorts of transactions require a lot of forethought, expertise, guidance. You need your accountant, your attorney to weigh in on these and help make sure that the gifts are being memorialized correctly and they're going to the right types of organizations. Many instances, donor-advised funds, organizations run through any number of nonprofits. Many of the big custodians, places like Schwab, Fidelity, etc., have their own donor-advised funds. They're particularly well suited to take these complex assets. A business owner, for instance, that's contemplating a sale of their business in the next year or two and recognizes, as I move off into retirement, I've saved enough, the business is going to give me enough in the form of assets to make sure that I'm maintaining my standard of living and all for myself and my family going forward, but I do have philanthropic inclinations. Those folks really should be giving consideration to potentially moving a portion of their business to charity in advance of the sale. Why do I say that? You could really pre-fund your philanthropic giving for a number of years, if not well into the future, by simply contributing it to, say, a donor-advised fund, as I just described. You'd want to make sure that you do this well in advance of any sale, any planned sale. You don't want it to be perceived as a transaction in anticipation of the sale. That would be bad. You wouldn't want the service to come in and say, you gave the asset away, but you really have to pay income tax on it. The objective here would be to give the asset away, capture an income tax deduction, obviously avoid a capital gains tax, and then in time, whether it's months or years down the road, when the business sells, that portion that's in the donor advised fund, say, for instance, gets the asset swapped out, receives cash, the buyer takes the stock, and now there's a liquid asset in the donor advised fund that can be utilized to help maintain your philanthropic giving well off into the future. Same sort of thing can happen with real estate. Life insurance oftentimes is a particularly attractive asset to give. Many people have policies that they no longer want nor need for whatever reason. And, it's certainly a viable asset to look to help achieve your philanthropic giving. So I touched on donor advised funds a moment ago. What is a donor advised fund? It's basically a pooled asset fund where you contribute assets to an organization. Again, it could be a Schwab or a Fidelity. It could be an organization like the Foundation for Metro West here in Metro Boston. These organizations run assets for philanthropically inclined folks. They'd segregate it. You could contribute assets into a donor advised fund, and as the term indicates, you would advise where the assets are distributed over time. What charities would be the recipients of those assets. It removes the administrative headache from you as the grantor and places that on the donor advised fund. They oftentimes will have assets managed directly by themselves. As the asset levels grow, typically around $250,000 of assets, you can have an advisor like 12 Points manage those for you. We'd welcome that, certainly. But donor-advised funds provide really great vehicles for long-term giving. As I said before, for a business owner or somebody that owns real estate that wants to give, pre-funding their philanthropic inclinations with an asset before a sale is a really good strategy. Private family foundation operates in a very similar sort of way, and except for the fact that you're actually going to be running it yourself as opposed to providing the assets to another organization in the form of the donor-advised fund. Private family foundations are very, very popular among wealthy families. Great tools for utilizing philanthropic gifts. Not as flexible in many instances as donor-advised funds. Sometimes the deductions offered for private family foundations are actually less than the donor-advised funds or direct to charity. So these are things that you might want to consider. But certainly for significant gifts, I'm talking multi-million-dollar gifts, family foundations can serve and do serve a really wonderful space in the market. There's many, many organizations that are out there that can help administer these things, from people that we're very close with here, organizations we're close with here at 12 Points. So to the extent that you have an inclination or desire to learn more about private family foundations, happy to speak with you about that anytime. And then we have a series of vehicles that I would say are really important for coordinating philanthropic giving and estate planning. Many instances, that's really where I spend my time, as I think most of you on the call know. That intersection of estate and philanthropic planning is really a wonderful, wonderful area for planning and for making an impact. So charitable remainder trust. What's a charitable remainder trust? Here, as the donor, you'd make a gift of an appreciated asset to a charitable remainder trust. Like the term indicates, the remainder at the end of some time period, either a set number of years, say 20 years, or at your passing, maybe the passing of your spouse, or the two of you, the assets, the remainder goes to charity. So during the pre-remainder period, what happens? You take the asset, you contribute it to the trust, you can receive an income stream back. So if you have an appreciated asset, maybe one that's not generating any income to you right now, a stock, for instance, that's not paying a dividend, you can contribute that to a charitable remainder trust, take an income tax deduction, the assets out of your estate from an estate planning perspective. And what you can do is sell the asset in the CRT and reinvest it into a different group of assets, different portfolio, if you will, and receive an income stream back. So you can take an asset that's generating zero income to you and turn it into a 5, 6, 7, 8% sort of income stream. Really, really attractive for those that are philanthropically inclined with appreciated assets going into retirement. Really a great technique for removing those assets from your taxable estate. Similar sort of thing is the charitable lead trust. Here, very similar vehicle, only the income stream and the remainder interests are flipped from the charitable remainder trust. In this instance, in the lead trust, the charity gets the income stream right out of the gate. So for, say, 20 years, a lead payment will be made to the charity. And then at the end of that time period, the remainder will go to some beneficiaries or trusts for the benefit of some beneficiaries that you may have chosen. A charitable lead trust is a fabulous estate planning technique and tool. Great way to push assets down to future generations without significant taxation. Really, really great tools. Big fan of both the remainder trust and the lead trust. I see less and less charitable gift annuities today. I'll just touch on it briefly. So charitable gift annuity would be something that, say you had an inclination to give to the YMCA. I don't know if they do charitable gift annuities. I suspect they probably do. So a nonprofit like that. And you didn't want to give them tons and tons of money, but say you had $10, $20, $30, $40,000 you wanted to give, but you kind of wanted an income stream off of it. It's the same thing. You'd give it to the YMCA if they had the gift annuity. You'd get the income tax deduction right out of the gate. The gift annuity would give you back an income stream for a period of years, maybe for life. And at your passing or at the end of that time period, the Y would receive the balance of the assets. So a really cool technique, a real simplified version of maybe a remainder trust, certainly less administrative costs there. And so here, donor-advised funds are a really great tool for year-end planning. We talked about that a moment ago. It allows you to make the gift now. As I said, you get the income tax deduction now, potentially. And then you can designate the charities later. So as I said, it allows you to pre-fund the charitable giving of yourself and the family without having to identify those causes that you might care about exactly right now. So it does work like a foundation without so much of the, quote, headache and paperwork. Not trying to scare you away from a foundation. Certainly for those that have significant wealth, private foundations can and are excellent strategies. But we are seeing a tremendous uptick in the utilization and acceptance of donor-advised funds here. So engaging your family in charitable giving is one of the most rewarding things that I think I've seen, and some of the most rewarding work that I've done with my families that I work with, that I have the pleasure of working with here at 12 Points. It allows you to really figure out what you're passionate about. What are they passionate about? And you can turn those gifts into conversations, right? Really want to be able to help figure out where the commonalities between your causes and their causes are. Many instances, they're not going to be very common, right? And that's fine too. Should be fine. It's not always fine. If mom and dad are the ones writing the checks, sometimes they have less inclination to fund the causes that the children care about, but that's all important. So making these conversations, having these conversations, are really, really important and can allow you guys as a family unit to think through what your wealth means to you, not only now and well into the future. Certainly, you can serve as matching gifts, as it says here on the screen. What do we mean by that? So if a child were to say, listen, I'm going to make a gift to a cause that I care about of X, the family can match it, or they could match it times a couple, depending upon their wealth. Many families that we work with that utilize donor-advised funds have the children go out, and vet various causes and come back, and around this time of year they're making their pitches to the family board, for lack of a better term, as to who they'd like to give to and why. And that allows them to get comfortable, the children to get comfortable analyzing charitable organizations, finding out who they care about and why, and making sure that the organizations are reputable, and then following through and making those gifts. Ideally, through the balance of the next year, you'd have them be engaged with the organization, track the impact of that gift, and kind of report next year the impact and what they learned through that process, and see if that's a cause that they want to continue working with going forward. I think it's important to recognize that some children and grandchildren will really pick this up and run with it, and others might be a little bit slower on the uptake, and just be patient with them. So we've got a couple of suggestions here for charitable giving in families. So The Generous Genes is a classic. The Opposite of Spoiled is also an excellent book. Two real good options here. Certainly, if you were to go on to Amazon and type in giving in families, charitable giving in families, you'd come up with a whole host of other books. These are just a couple that might be of interest to you. I've probably got 10 or 15 more on my file cabinet behind me here. So in the interest of time, we're going to move forward and talk about gifts to family. Why do we want to give to family during our lifetime versus at death? Many people like to see the impact of their gifts now. Can address current needs. This is so important, right? Help your children and grandchildren understand the value of money. And also can serve as a little bit of a test. How are they going to manage assets later, right? That's a real big thing for many of our clients, is they want to make sure that the kids understand the importance of money and how to manage it. And then, there are those that want to keep the fire in their belly, meaning, they don't want to make what we refer to all the time as trust fund babies. So they want to make sure that the children work hard. So, giving during lifetime for important needs is great, but not lumping it all at passing. I think it's oftentimes viewed as a good tool for making sure that the kids remain grounded. We've got a little quote in here on Plato that you can read. We're really focused on trying to help families think through what their wealth means to them, and conveying that down to the children and grandchildren for that matter. So annual exclusion gifts currently are $15,000 a year, $30,000 if you're gift splitting with a spouse. You can make direct gifts of tuition payment and or medical expenses that do not go against your annual exclusion gifts. And of course, you have your lifetime exemption, which is now massive and exceeds $11 million per spouse. So you can make gifts either outright, simple cash gifts, can set up savings accounts, can utilize 529 plans. This is a particularly cool technique. Grandparents love this. So the grandkids come along, they've finally made their wealth, they feel comfortable, they want to make an impact in their grandchildren's lives, help their kids at the same time. One of the biggest expenses that families confront today, as we know, is education expense. So how does a 529 plan help? Grandparents in this scenario can make a gift to a 529 plan for the benefit of the grandchild. Assets in that vehicle will grow tax deferred, come out tax free so long as they're utilized for qualified higher education expenses. Really a cool technique. Even cooler when you think of the fact that you can pre-fund that 529 plan by the tune of to the tune of 5 years gifts in advance. So what you can do is take 15,000 times 5, so you end up with $75,000 going into a donor-advised fund for a brand new grandchild, 150 if you're going to gift split between spouses. So grandma and grandpa in that instance there could put 150 right out of the gate into a 529 plan for a grandchild. It's a real cool technique. Grandchild gets the benefit of 18 to 20 plus years of growth. Mom and dad have a little bit of the edge taken off for qualified higher education expenses. Real cool technique. Certainly, utilizing loans is another strategy that can be utilized here between families. Interfamily loans are particularly attractive now in light of the fact that interest rates are as low as they are. And certainly, never far from my mind is the use of an irrevocable trust, a technique that there's any number of flavors. I can't even get into the various myriad of trusts that we have available to us as practitioners here. But the benefit of all of these irrev trusts is that you're really providing protection on the assets for the beneficiaries. You're giving them expertise in the form of asset management, administrative management, and you're really protecting those pools of assets. So who are you protecting them from? The cast of characters that I like to refer to as the creditors, predators, and divorcing spouses. So the assets in an irrevocable trust, so long as it's drafted appropriately and properly, can protect assets from lawsuits. Something happens to one of your children if they're getting divorced. Say there's a horrible accident that they're involved in, whatever it may be. Maybe they're in a very litigious business. They're doctors and brain surgeons, and something can happen, as we know. So using irrev trusts as gifts, as the ultimate recipient of family gifts, Really, really important stuff. Can't stress that enough. So, important to pay attention at the end of the year, I like to say, to your estate planning. It's always a great time at the end of the year to revisit your planning. Do your current documents accomplish your objectives? Have those objectives changed in any way, shape, or form? Are the trustees and executors still appropriate? Will the assets be protected from those creditors, predators, and divorcing spouses that I just described, or do you have an outright distribution scheme? I've seen many documents recently for clients in New York and New Jersey that are relying upon wills that just distribute assets into testamentary trusts for the benefit of heirs. I really prefer the use of revocable trusts. A revocable trust is going to be a vehicle that will allow you to have the ability to avoid probate if set up properly and funded properly. Really a great way to manage assets in the event that you become incapacitated, because the trustee will manage it. You won't need to rely upon a durable power of attorney holder. So there's a whole host of reasons to pay attention to your estate planning and review those documents every couple of years. I think it's a great thing to do at the end of the year. It's certainly a great thing to do if we're contemplating any gifts to children. You know, some people refer to it as that last gift. You want to make it count. So thank you for your time today. A minute over. I tried to get this done in a half hour. Chris Cahill, 12 Points Wealth Management. You see my contact information right there. Please reach out with any questions. We're happy to serve in any way, shape, or form that we can, provide any guidance or introductions that we may be able to for you. So thank you all for attending this lunchtime webinar, and we try to get them done in a half an hour so that you can get back to your workday. So thank you for spending your time with me today here. Enjoy the rest of it. Bye-bye.